So someone wants to know if they own two businesses, can they share expenses between them to save on taxes?
In most cases, it doesn't matter whether you share them half and half or 95-5 or whatever, because the vast majority of businesses are flow-through entities, meaning that the are going to be the ones who are picking up the income, the net income, which is revenue minus expense, and then they're going to be paying their individual tax based on whatever that number is. So if I have $5,000 of expense in company A and zero in company B, when it gets to me as a flow through, then it is still $5,000 in expense. If it's 2,500 and 2,500, it's still 5,000 in expense. If it's 1,000 and 4,000, still 5,000 in expense. As long as we're talking about pass-throughs, usually doesn't matter. Now, if you have different ownership structures between different entities, then it can matter. So if one is a partnership and you're only 50% and you're 100% on another S corp, then yeah, you want to make sure that you are getting the full bang for your buck, and your partner in that other company isn't siphoning off your deductions. Also, if you have a non-pass-through company like a C corporation, then it definitely matters because they're totally siloed. You got to be mindful of what money's going where and to whom, and as long as you follow those kinds of guidelines, then the net result is going to be the same either way. Now, with that said, it is a good idea to apportion things accurately, because especially when it comes to, even though it doesn't impact your current year taxes, it will impact your sale potential. Because, when you go, the biggest problem when people try to sell their businesses is having accurate books. So if you have a clean set of books that is accurate and actually reflects the performance of that business, it is a much easier sale than if it's like, $5,000 comes in over here, but this other company that I have over there is really paying for the phone system for this company, so we got to work that in. And it's a whole lot of cover, or the other way around. This expense, it's on this business, but really it belongs to this other business. So really, my net profit should be higher, and I should get a higher sales price as a result. Those are hard conversations to have and make negotiations more difficult. So you want to accurately reflect the performance of that business so that when that time comes, you can make a very simple representation in a sale process. So that's the main reason to do it. If you want to be super thorough, a lot of times what we'll see is if somebody has like a portfolio of businesses, we'll have a management company that actually leases out employees and resources to the subsidiary companies, and that way the flows are fully accurate. So again, it doesn't change anything on the net, but what it does do is it puts the expenses where they belong in the different company structures. So that's, again, it's more administration, but if you have a portfolio of companies, you're just dealing with more administration. That's just how it goes. Be careful what you wish for. And on top of that, there is another concept that I don't think enough people comprehend or put into place, and that is the concept of economic value added. So basically, every business operation should have a profit. And what that means is that, so let's say we're going through that management company that leases out employees and resources and everything to subsidiary companies. I've got a marketing guy, right? If I'm renting my marketing guy to my subsidiary, I need to be renting that not at cost, but at profit. So if my marketing guy costs $50 an hour or whatever, I'm not going to be selling him his time to my subsidiary for $50 an hour. I'll be selling him his time to my subsidiary at $75 an hour, so that I am making sure that I am, one, representing a true cost if I went out on the third-party market to replace that function in that subsidiary business, and two, I need to make sure that is still profitable enough that it's worth doing. Because if it's not worth doing, then you have to look at other solutions, and you shouldn't have that person in-house. When you force yourself to focus on the business unit profit, it a lot of times reveals that you're just wasting money that you could be done in other ways or cheaper or just eliminate entirely when you actually take a real close look at it. That's just, again, that's not a tax issue because revenue on the one side will show up as expense on the other. It's a wash, but you want to make sure that from business operations side of things that you are doing things the most efficiently that you can. Yeah, it depends.
It depends.
All right, I'm